Hello, my name is Andy Ho. I'm the Chief Investment Officer of VinaCapital. This is the next part of the series of articles and videos about how Vietnam can reboot its economy after the COVID-19 outbreak. Today, I want to discuss foreign indirect investments, FII, how Vietnam can attract more FII post the COVID-19 outbreak. Before I introduce the concept of FII, I would also like to introduce the concept of FDI, which is foreign direct investments. Vietnam is able to mobilize capital from abroad through two channels. One, foreign direct investments, the other, foreign indirect investments. Foreign direct investments tend to be longer terms and they're project-based and they're fully controlled by the foreign investor. These can be projects like factories, buildings, condominiums, and infrastructure. These are just examples. Whereas FII is foreign indirect investments. It is participating in the capital markets in Vietnam. It is purchasing stocks and bonds. It is investing in private equity. It is investing in venture capital. So this is what we call FII. FII contributes to the trading volumes that we see today in the stock market. In 2019, the trading volume is roughly $150 million a day plus. Today, we're seeing volumes of $200 million plus per day, trading volumes. This is mostly driven by retail and domestic investors. How can we get more FII to participate in this trading volume and increase the quality and depth of the stock market? Okay. So what's happening today in the global economy? As you're aware, we are going through a COVID-19 pandemic. COVID-19 is causing a lot of economies and businesses to change for the worse. And as a result, governments around the world, particularly developed economies, are supporting their economies and businesses by printing and pumping out more money, a lot more money. At the moment, we believe that developed countries around the world are pumping in an aggregate of $6 trillion to support their developed economies. So, how do we get some of this money into Vietnam in the form of FII? We need to get it into Vietnam because we wanted to support the stock markets, we wanted to support the capital market, etc. But we need to make some changes in order to attract more FII. This is a great opportunity for Vietnam to make some changes and reforms so that we can attract more FII, money that's coming out of central banks around the world being put into the market to support their economy. We want to attract some of that money into Vietnam in the form of FII. FII has supported the stock market globally. As an example, in the global financial crisis, by the way, today $6 trillion is over 3 times the amount of money that developed economies pumped into their economies during the global financial crisis. But during the global financial crisis and after the next 11 years, the stock market in the US went up 5 times. At that same time, earnings only went up 2 times. So clearly the liquidity and the capital and the money being pumped into the economy has supported the stock market significantly more than earnings growth. Why Vietnam? We believe that investors in these developed markets who have access to money being pumped out from the central bank, we believe these investors are still very attracted to Vietnam because we believe that Vietnam provides returns that are not available to them in their countries. So there are limited returns for them to choose from. Their economies, bonds are trading at negative interest rates. The term deposits are negative. The dividend yield is coming down to 1 or 2%. So the return potential in their economy is very low. Therefore, they're looking at places like Vietnam where we have dividend yields of 3 to 4%, bond yields at 3 to 4%, term deposit 6 to 7%. So the return in Vietnam is tremendous. At the same time, Vietnam presents a very stable political environment as well as an economic environment. Our currency is very stable. So when an investor invests in Vietnam, they can see the asset appreciate and see that the currency is stable so they're not losing return as a result of a depreciating currency. So in addition, Vietnam also presents a case where there's 97 million people and growing. Over half that population is under the age of 35 and their income, their middle class income, the average income today is about $3,000 per annum. This income is only rising. As a result, the purchasing power is rising. So that becomes very, very attractive for businesses as well as foreign and domestic investors. So in summary, we need to access foreign capital being pumped out by the central bank. We need to make some reforms to make it more attractive for foreign investors to invest in Vietnam. We know that with experience and history that these money being pumped out by central banks do support the stock market significantly. Vietnam saw its stock market go up 50% in 2017 when the European Central Bank pumped out $1 trillion. We also know that investors are attracted to Vietnam because we have a great population that's growing and its income is growing, and politically and economically we are very stable. So the key is we need to make some changes and reforms to the capital market in order to attract more foreign indirect investment. So what are the changes and reforms that Vietnam needs to embark on to attract more FII? Remember, there's $6 trillion being pumped into the global economy through central banks. We need to access that money. Before we go into the recommendation, I think it's worthwhile for us to look at some of the concerns and comments from foreign indirect investors about the capital market in Vietnam, particularly the equity market for now. One, they want to see more growth opportunities, more companies that are growing. They want to see the opportunity to invest in more of these companies on the stock market. They want to see bigger size of companies on the stock market. They want to see more equitization of SOEs and the percentage being equitized much larger, so the opportunity becomes much larger. They want to see the opportunity to invest in corporate bonds. At the moment, most corporate bonds are inaccessible by foreign indirect investors because these bonds are not listed. They also want to see, in general, a more diversified stock market. Today, our stock market is predominantly driven by financial institutions like banks and real estate companies. They want to see a more diversified stock market that includes telecommunications, electricities, utilities, companies, and etc., or even healthcare into that diversified pool. They want to be able to purchase shares of companies that have no foreign room and not have to market down to the price after they've purchased it. At the moment, we have 30 companies that are trading at this foreign ownership limit. As a result, these foreign investors have to buy the shares from another foreigner at a premium. But the stock price is at a lower price than the purchase price. Therefore, after they make the purchase, they have to mark down the share prices. They have to mark down about 10 to 15%. Right now, 82 companies in the stock market have lifted their foreign ownership limit after 2015, but 30 have ran out of room. So therefore, it makes it very difficult for foreign indirect investors to buy into these companies without having to market down once they make the purchase. They want to have a more liquid stock market. More liquid stock market means more quality, higher quality, more depth. Okay? So what are the recommendations and changes that we have in mind? One is we should privatize or equitize more businesses, particularly in the telco or the electricity or the petrol space. We want to equitize larger percent of the business. Instead of 3 to 5%, we want to see 20 to 30% of the business being equitized. We want a foreign board that reflects the transaction price of the shares being bought and sold by foreigners. Therefore, having a foreign board, they don't have to mark down the price of the stocks that they just bought at a premium. We also think that Vietnam should graduate into emerging market, MSCI emerging market quite quickly. We should. Today we are in MSCI frontier market. When Vietnam graduates into the emerging market, we will have access to over 100 times the capital available today as a foreign market. That's as a frontier market. So we will have 100 more times capital available for investing in Vietnam. In order to move to MSCI emerging market, we have to have better disclosure, better transparency, and better corporate governance, more or less on the international scale or level. We want a better pension business. Pension, we don't have a voluntary pension business today in Vietnam, but pension is the backbone of most capital markets around the world. It creates a foundation for this capital market to be stable and large and of high quality. So we need a pension business. More immediately, we recommend that perhaps over the next 6 to 12 months, we reduce the corporate income tax rate significantly to encourage growth. We also recommend trying to push down the deposit rates at banks so that people will be encouraged to invest in factories, businesses, stocks, and even real estate. The term deposit rate now, 6 or 7%, is quite attractive. And if we can reduce the term deposit, people would be able to move that and invest in a stock market. We also recommend that Vietnam goes through a marketing campaign what we call a global investor conference, folks in the brokerage houses or even fund management companies like ourselves, with the support of the government, we market Vietnam. Okay? So that's on the equity side. On the bond side, investors want access to liquid bonds or listed bonds. Corporate side, predominantly, we have government bonds listed already. Now we want access to corporate bonds. So we need it to be liquid and we need it to be listed. In order for them to be listed, we have to go through a rating process. Today we have international rating agencies like S&P, Moody's, and Fitch. We should invite them in to Vietnam, rate these papers or the corporate bonds, probably do it under a joint venture with a commercial bank or a financial institution in Vietnam. So effectively, one of these international rating agency would do a joint venture with a financial institution in Vietnam to rate the corporate bonds, and then issue the corporate bonds through an underwriting process and list the corporate bonds on the stock market. Once listed, then we have to have a market making to create the liquidity for the corporate bonds so as to make it very attractive. So as you can see, we have no shortages of ways to change and reforms in order to attract more FII. Vietnam has been very quick and decisive in fighting COVID-19. We believe that Vietnam should be as quick and decisive in implementing reforms and changes to help the capital market in the coming months. The reason is very simple. There is over $6 trillion of money being pumped out by central banks around the world. Vietnam needs to access this money through FII. We need to make these reforms to make FII come to Vietnam, to make Vietnam even more attractive to foreign indirect investors. Thank you.